We're kicking off today with the Federal Reserve's latest beige book, which landed with a sobering message for anyone hoping the American consumer is back on solid footing. The report highlighted World Cup soccer activity as a genuine short-term lift for bars and restaurants across the country, but the Fed was careful, almost pointed, in refusing to characterize that boost as anything resembling a durable economic trend. With the S&P 500 sitting at 740.86, the Nasdaq 100 under pressure at 682.12, and the VIX elevated at 18.35, markets are clearly not dismissing the Fed's caution. This is the story traders need to unpack right now. The Federal Reserve's beige book, released 8 times annually to inform FOMC deliberations, specifically called out World Cup soccer activity as a driver of temporary foot traffic and revenue for the leisure and hospitality sector, particularly bars and restaurants. But the framing was unmistakably cautious. This was an isolated, event-driven pocket of strength, not evidence of broad-based consumer momentum. The report's overall tone flagged uneven spending patterns across regions, with consumer activity described as selective rather than robust. The 10-year Treasury yield sits at 4.60% today, and the Fed's language does nothing to build the case for imminent rate cuts that equity bulls have been pricing in. Here is the critical macro transmission mechanism. When the Fed's own anecdotal survey distinguishes between event-driven spending and fundamental consumer health, it is signaling that the FOMC will not be persuaded by a single quarter of hospitality data when deliberating on rate policy. Consumer spending accounts for the vast majority of U.S. GDP, and if the underlying trend is weakening outside of scheduled global entertainment events, the Fed's higher-for-longer posture becomes even more entrenched. Prior beige books in 2026 have already flagged mixed consumer activity, and this edition's World Cup commentary reinforces a pattern of selective, rather than broad, economic resilience, a pattern that complicates any dovish pivot narrative. The most direct casualties of a structurally fragile consumer are consumer discretionary names. Consumer discretionary faces real headwinds if household spending is event-dependent rather than income-driven. Darden Restaurants, one of the largest full-service restaurant operators in the country, benefits from World Cup foot traffic in the short run, but a cautious Fed read on spending durability limits the upside narrative for the sector. The Russell 2000 ETF is deeply exposed here. Small-cap domestic companies live and die by the American consumer's wallet. The Nasdaq 100 at 682.12 is already down on the session, and multiple compression risk rises if lower growth expectations weigh on earnings outlooks for discretionary adjacent tech platforms. Traders should lock in these specific levels right now. The S&P 500 at 740.86 is holding support, but a break below 735 would signal a broader deterioration in market confidence. The Nasdaq 100 needs to defend 675. A close below that level triggers a more serious tech-led sell-off. On the rates side, the 10-year Treasury yield at 4.60% is the critical floor. A sustained move below 4.50% would be the market's loudest warning signal, yet on growth concerns, simultaneously supporting a bond rally in long-term treasuries. The VIX at 18.35 is elevated but not yet in panic territory. Watch for a breach above 20 as the stress threshold. Gold and W&T offshore crude, up significantly, add further complexity to the consumer spending backdrop. The beige book's message is unambiguous for portfolio positioning. World Cup spending is a sugar high, and the Fed knows it. Durable consumer health would require broad-based income growth and sustained discretionary demand, neither of which this report confirms. The higher-for-longer rate regime stays intact as long as the Fed sees no compelling evidence of structural consumer resilience, keeping pressure on consumer discretionary and the broader the Russell 2000 complex. The rotation trade that makes sense here is defensive. Utilities and consumer staples offer shelter if growth fears deepen, while long-term treasuries becomes attractive on dips as the 10-year yield at 4.60% risks moving lower. That is the one story that matters today. The full breakdown is right here. If this breakdown gave you an edge, hit subscribe and ring the notification bell. We publish these deep dive market recaps every single trading day, so you never miss a move that matters.